we didn't want to just jump into the biggest apartment complex. We wanted to start out, around 30 and then 50, 60. Now our new one is 160 units. So for us, it's just like we wanted to build organically, and that kind of takes time, but it's marketing at the end of the day. And that's what you kind of have to wrap your mind around, is the skills are completely different than finding and negotiating and running a deal, as opposed to raising money for a deal.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Today's guest is Stephanie Walter. She is the CEO of Erbe Wealth. She's a capital raiser, a syndicator, and real estate investor. She recently retired. She sold her insurance agency of 16 years. And her claim to fame is that she teaches professionals to unlearn what most of us have been wired to think about money. She's a gateway between professionals and well-vetted deals. She lives with her husband and young son in Colorado. And just excited to have you on the show today, Stephanie. Welcome to the show.
Thanks for having me. I'm excited to be here.
The pleasure is mine. There's a lot of things that we want to cover today, really, talking about what you think about money, debunking money myths, talking somewhat about why you don't particularly love 401ks. There's a lot of stuff to cover. There's 3 questions I ask everybody who comes on the show, though. Can you very quickly tell us where you started, where you are now, and how you got there?
Well, goodness, where I started was, I started just like almost everybody else. I had a W-2 job, worked there for about 8 years. I was sat down for a review, and they said, well, you did a great job this year, and we think you'll get the best raise that we have, which is 2%. And I said, I went home to my dad, who was alive at the time, and just was like, Dad, I worked out what this 2% raise is going to look like for the rest of my life. And I can't see myself, I don't know what to do. And he's like, well, what will happen if you stay where you are?
Right.
He said, but, or you can go out and do it yourself and be your own boss. He was an entrepreneur, so I'd seen him do it. And so that's where I started. Where I am now, took many years to get where I am now. I did start an insurance agency and had done it for 16 years. I've always loved real estate. So all the way along, I was investing in real estate, and eventually got invited to a boot camp about investing in multifamily properties. And when I went into there in 2016, I felt like I had found what I've been looking for my whole life, and loved the whole idea of syndications. I thought it was an amazing opportunity. And then from there, I just started, throwing myself into that, and found out that I really like capital raising, and found a partner who really likes finding the deals. So we're on our 8th deal together right now. But what I learned along the way is definitely dealing with very wealthy investors really changed the way that I viewed how I was personally using my money. So in 2018, I started, changing where I had my money and how I was using it. And within a few years of doing that, then I was able to retire out of my insurance job. So I think retiring sounds different than it really is in my day-to-day life. I still work because I love raising money, and but I get to do what I love, which is what retirement means to me.
That's fantastic. Absolutely. Your retirement means to you get to do what you love. That's tons of fun. Talk to us about some of the things, maybe, you said as you started to raise capital and you started to interface with wealthy investors, what were some of the light bulb moments as you saw the way they handled money differently? What were some of those things?
Yeah, well, it took a long time for me to put the pieces together, but I did notice, looking at their financials, I noticed a lot of these very wealthy people had no 401ks, had no IRAs had no money, or if they did, they were really insignificant in relation to what their wealth was. And I found that interesting, I guess, because I also take money from investors that are, kind of average, middle of the road people, and their finances are almost exactly the opposite. They have everything in the 401k. Maybe they're going to try out a syndication, and so that's a very tiny percent of their wealth. So yeah, that was the first thing that I noticed. It took some time to figure out why, and to talk to some of these investors who became my friends, to understand that one of the things is the wealthy want to have full control of their money at all times, and largely the wealthy want to invest in tangible assets. Like they want to invest in real estate, but not, they want to invest directly in real estate, so through a syndication type of situation, or they want to invest directly in a business, not a mutual fund, or the stock market. They want to invest directly into where they're investing, and they can vet the people running the business, their business plan, what they plan to do. So that's a whole different mindset than most of us have.
Absolutely. Absolutely. Yes. You touched on a few things there. Full control. They like tangible assets. They want to be direct investors. Was there any other compelling reasons that you saw them, maybe in particularly, because, obviously self-directed IRAs, self-directed 401ks, all those things are touted pretty heavily in the real estate investment space. So why did you find, when you got into these higher net worth individuals, that was there any other reasons they maybe didn't have those 401ks or things like that?
The biggest one, ends up being that a wealthy person wants to know how much, and they do know how much money they have at any one time working for them.
Sure.
The problem with the 401k is you have an idea of what your money is going to be worth in 20 years, but you don't have any. No one can tell you exactly how much money that will be. No one is going to be able to tell you what inflation is going to do to that. No one, but specifically for wealthy people, their biggest hang up with that is unknown tax ramifications. And that's just something that they don't deal with, period. Like in every interaction I've had with them, they understand what tax ramifications are going to mean going in and what tax ramifications are going to mean going out. They have a plan to mitigate their taxes. And a lot of people don't quite understand that, but for wealth building, taxes take a huge chunk out of everybody's wealth. And so if you don't have a plan on how to mitigate those taxes, it's a huge, huge problem.
For sure. And that's something, wasn't it Robert Kiyosaki that said there's two sets of tax laws, one for the informed and one for the uninformed, right? Yeah. And that's the same idea there, that the poor and middle class, aren't going to spend their time really studying, okay, if I move X, then that equals Y in taxes. So, I think that's an intriguing point you bring up there. I think about that, not just from an investment side, with your capital into a passive syndication, but maybe even as an active investor on the property tax side. You own something, and right, like what's your biggest expense that most of us run into when we buy something? Right. It's our property taxes.
Exactly.
So considering that, and that's a very interesting point that we talk about some, but probably not enough. So that's really intriguing. That you learn those things kind of as you started to raise capital along the way. So talk to us. What are some money myths maybe that you actively pursue debunking?
The 401k is up there. But I think a big one that's a surprise to a lot of people is they feel like the wealthy investor is wealthy because they put their money into high risk type of investments. So high risk, high reward is the myth, I believe, there. Right. But the truth is that most wealthy people that I've ever worked with are extremely they do their due diligence, and overall they invest in things that have very low risk profiles, like syndicated multifamily real estate. If you do your due diligence, that's one of the highest returns versus low risk profile type of investments out there. So they like to control and understand, very many aspects of what they're investing in. So no, they're not just throwing their money into high risky things that I've seen. Now granted, I work with probably a smaller group of high net worth investors, but I think there's a good chunk of them. They're not out investing in cryptocurrency that I've seen. So
right. I think that's a good point. We often say that there's a correlation between risk and reward, right?
Mm-hmm.
The higher the risk, the higher the reward. At least that's been stated. And it's funny, somebody said that to me this weekend, and I kind of was like, it took me back a little bit. Like, no, I'm not sure I agree with that. We're buying things that produce an income. And to them, because it produces a higher return, it says, well, that's a higher risk. Like, well, yeah, maybe, except when we buy it makes money from the day we buy it. So I'm not quite sure I agree.
Yeah,
so
that's correct. Yeah, I agree with that.
What's it been like on the insurance side, transitioning from, selling insurance and running an insurance agency to now going out and raising capital? How was that transition, and what did that look like for you getting your first deal done?
Yeah, it was, my first deal I did at the end of 2018, and I did that one by myself.
Oh, wow.
So that was, and I realized after doing that one, I didn't ever want to do it by myself again. So I really, focused on the capital raise, and that I see a book behind you that I read last year, I think, and gosh, I wish I would have read it when I first started, which was The Raising Capital with Hunter Thompson. But there isn't I personally didn't have a lot of help in raising, so I learned a lot by what not to do as opposed to what to do. And there was actually, I just was thinking of this the other day. I was like, when I left insurance, I didn't get any clients that came for me from insurance and then wanted to invest in real estate. And so it's and I think it's just, that's how people view you. I was the insurance agent, and
Right.
it's hard to switch into what I was doing at the time. But I did find, and I think everybody could use this when they start, is just, writing out a list of people that, if you're in a business before, like I knew people that liked to send me referrals. They're just kind of the givers, really nice people. And so I went to approach those particular people, not necessarily for them to invest, but for them to know what I was transitioning into. And from that's where I got some fantastic referrals. And, it doesn't happen overnight. Thankfully, my partner kind of wanted to grow slow. Both of us we didn't want to just jump into the biggest apartment complex. We wanted to start out, around, 30, and then 50, 60. Now our new one is 160 units. So for us, it's just like we wanted to build organically, and that kind of takes time, but it's marketing at the end of the day, and that's what you kind of have to wrap your mind around. The skills are completely different than finding and negotiating and running a deal, as opposed to raising money for a deal.
That's a good point, and that's a strategic shift in thinking on the capital side that I think a lot of us, I know that was even an epiphany for me probably earlier this year, when I'm like, wait, I'm 100% in the marketing business. Like if if we've got partners that are bringing the deals, I'm all marketing. And I'm not really in the real estate business. I'm in the marketing business, which is, it's a little bit of a mind shift there. You touched on something early on or a few minutes ago. You said you learned a lot of what not to do early on. What does that mean?
Well, I think even I heard that in Hunter Thompson's book, is like he thought he would have this dinner and do this wonderful presentation, and then everybody would just be clamoring to invest with him. And I kind of did the same thing. Like I wasted a lot of money on my presentation materials, like, this is who we are, this is our, brochure, isn't this pretty, don't you want to invest with us? Also I went to a lot of networking events that revolved around real estate, and thinking that, I would get investors from there, and wasted a lot of time to realize that that was not the place to go to get investors. For me anyways. What I found is just like people that run businesses, people that possibly are selling their business and want to downsize, people that understand how businesses run, and seem to be a really good person to talk to about this. And because really an apartment complex is just a big business, it's just a business. Essentially, you got your income and expenses and your cash flow, and that's what it is. And so, but I do go on podcasts because I really want to educate people, because I do get a lot of wealthy people and they get it, but I want to get the people in these opportunities that have never heard of it, just like I hadn't a few years ago. And I mean, to understand that how that cash flow can completely, change your life. And that's really who I want to find.
Right. What's it like? Maybe talk to us about the first time you interact with somebody who's never heard of a syndication. What's that? What have you found the timeline to be from, getting them up to speed on their education, industry terms, knowledge, to then finally across hey, I'm comfortable with this and I want to invest. What's that process like?
It depends on where they come from. If they hear me on a podcast, they're most likely ready to go. As soon as they, the concept hits with them, they're ready to give it a shot. But there's a couple different types of personalities, which I've come to understand. Like there's the personality that likes it, but I call it the paralysis of analysis, and
right.
They just can't pull the trigger. And that's as frustrating for them as it is for me. But I think there are personality types truly that get this and some that don't. I certainly, if I have someone that can't, decides, no, not right now, then I just put them on, again, a list, and I have tons of content that goes out to people, educational content, and maybe they will come around or maybe they won't. But, I just feel like it's good to get the information out there.
Do you put out like a weekly newsletter? What's a good hack, if you will, for producing content that people want to engage with?
I think for me, I just do a little bit of everything, because I read a book called Oversubscribed is the name of it. It's a great book of how to get a group of people to become kind of your raving fans. And it's really important to hit the people with like lots of different types of content. So, like a blog, to, podcasts. I don't have my own podcast, but, that I would be a guest on this one, then I will send out to everybody. I produce these like small videos, and they're like about the 30 questions that I get asked most from every investor that I talk to. And so those are kind of like the video portion of it. And so I think you just have to be consistent and keep sending the information out. I'm still kind of new to all of this, because I really kind of dug in 2019 as a capital raiser. So I'm still, kind of figuring it out, but I know that, the content is huge. And I think people spend a lot of time trying to get a wide group of net out there. And it really is kind of a skinny, tiny little pole that you put in there, and you find the one person, then the one person, tells the other person and the other person, because I think if you can recognize the people that are kind of the givers, and you recognize those personalities, I think, that are happy. If they're current investors, they're happy with getting their monthly distributions. You call them, ask if they know anyone, or, I don't think it has to be necessarily hitting everybody, because I think probably like what they say, 80% won't do anything, 20% will. So that's really where all your energy should go.
Right. I love that. I love that. Yeah. And I think that's something that, people worry a lot about producing content or putting stuff out there. They probably overthink it. It's getting it out there and getting it done probably that counts more than anything. Before we transition here into the final questions, I wanted to ask you one about your name of your company. What does Erbe Wealth mean?
Erbe is it's German for legacy, a legacy of wealth, which actually my father was the second generation. His father came over straight from Germany to work in a farm, and they sponsored them back in the day. And once he did that, then he went out and started some companies. And then my dad, he was an entrepreneur as well. He passed away about 16 years ago, but this was just my way to honor him, because I felt like the reason I'm here in this position is partially because I had the mindset open pretty early to being an entrepreneur and looking at things differently. And that was from him. And so I want to give people, a legacy of wealth in their family too.
That's fantastic. I love that. I love that. Thanks for sharing that with us. Last few questions for you here are this. If you were to help our listeners avoid one mistake in real estate, what would it be and how would you avoid it?
To avoid one mistake in real estate, I think the biggest thing, if you're getting into real estate and you don't know what you're doing, because I come across people that have invested in syndications where you're like, oh man, that might not have been the best choice for you, is actually to just reach out to someone who is doing it, who is either a syndicator or an investor. And I'm always happy to get, because my investors are awesome and they love talking to people. But to find a mentor, that's how I got where I am. I've had lots of mentors through my life. And if you find someone that is doing what you want to do, and most of the time they are thrilled to help you. They're more than thrilled, they want to. So if you can just be under someone's wing rather than doing it yourself, I think is that would be my number one way of avoiding a mistake.
That's fantastic. That's great advice. Next question for you is this. When it comes to investing in the world, what's one thing you're doing right now to make the world a better place? When it comes to investing in the world, what's one thing you are doing right now to make the world a better place?
Well, I feel like teaching people about these alternate investments rather than being stuck in the 401ks gives people a lot more freedom, and the passive, that passive income, that cash flow gives people so much more control in their own lives, and they're not handcuffed to, say, a job that they hate. It certainly gives them a lot of freedom. And so when people aren't feeling so trapped and they have more options, I would hope that they would do, things to make the world a better place.
Right. That's great. That's great. Stephanie, if our listeners want to get in touch with you, what is the best way to do that?
That is just on my website. You can go to www.erbewealth.com, and you can, we have an investment report we just put up there, the 5 reasons that passive investing might be for you if you haven't heard anything about this investing before. But yeah, I have tons of content, and that's what it's there for, is to help my people really understand this type of investing. You can also be put on a list where we send out, any type of investment opportunities we have, as well as educational content.
Fantastic. Stephanie, thank you so much for your time today. I do appreciate it.
Thank you so much.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much, and hope to catch you on the next episode.